It is the problem of having smart people with lots of things to say.
Yeah.
Exactly. Anyone who has some conversations, please come up and we'll talk during the networking break. Please join me in thanking our panelists.
I'm delighted to say, due to some heavy-handed work on my part, we're pretty much on schedule. My name is Bob Cecina. I'm the other half of the Iman Bob Show. I should say I'm the other quarter. Iman's really 3/4 of the lifting on this effort. I'm delighted to be with you here today. We're now going to have a series of kind of rapid-fire use case discussions on blockchain. They'll be done in sort of TED Talk fashion. I'll be introducing the speakers, and we're starting off with someone well known to you, Dante Disparte. And Dante is the CEO of Risk Cooperative. I won't introduce him further. I just gave a plug for his business. Dante?
All right. Thank you, Bob. So if it's going to be TED Talk, like, what could you say about why you should listen to me right now? Why blockchain matters in 8 minutes. Is that the time I have?
Yeah.
All right. And so typical TED Talks, they pause, they pontificate, they mill about. I won't do that. But I will tell you some very sobering things. The first is that 40% of our country, if we're just talking about the United States, 40% of the people in the United States can't afford a $400 setback. Think about that for a second. Without tapping credit or some alternate form of capital, someone in this room, if not 40% of you in this room, although I suspect you're not in this class, can't afford a $400 setback. Hold that thought. In the 50 years up until 2000, in the United States of America, on average, we had 24 disaster declarations in the country. In the 18 years since, the average annual disaster declarations is 124. Very hard to build a fortress nation in that kind of world. Very hard. 2017, to put it into stark relief, was between a $300 and $500 billion year, and that's just the share of losses that hit my industry's balance sheet, the insurance industry. $5.5 trillion industry. The entire industry last year, it suffered what we call the loss ratio. The combined losses were between 103 and 107%, which means that for every dollar of capital we had on risk, we lost 7 cents on the dollar. So if you think about some of those stats, and you look at communities like the city of Houston, which in 2017 had more rain dropped on Houston than any weather event recorded in the U.S. history since. It functionally collapsed the GDP of the 4th largest city in the United States and the choke point for 25% of our oil and energy capacity. So in those types of environments, the word resilience, the 3 things that define my company, risk, readiness, and resilience, they're not abstractions. When Harvey hit Houston, FEMA had $1 billion in its budget. And we needed an 11th-hour emergency line of credit from Congress to respond to one event. But surprise, surprise, complex risks don't recognize quorum, nor do they recognize when Congress decides to give out lines of credit. So immediately thereafter, we had Hurricanes Irma and Hurricane Maria. In Hurricane Irma's case, flattened parts of the Caribbean, Necker Island, where I was with Tamika. I went there and we created a hurricane. Tamika went, he created some world-changing initiatives. But the hurricanes bring in some really stark opportunities for us to make the world more resilient. The type of resilience we cannot deliver in my industry without blockchain. Here's blockchain solution number 1 in the risk and insurance industry. Our industry's expense ratio, so the cost of capital, it's not even the cost of capital. It's the operating expense ratio of every dollar of risk capital in the global insurance market ranges between 30% and 50%. So if you think about that in economic terms, it's very hard to get resilience down to the last line. It's very hard to improve household resilience when the insurance balance sheet is saying, I need 30% or 50% of that capital on risk in order to substantiate my existence and my overhead. So imagine using this type of technology at the capital formation layer. I'm not saying to the insurance underwriters and actuaries, throw away your models. I'm just saying imagine an engine in which you had a 30 to 50% pricing advantage on the capital that you organize. In exchange for that resilience being pushed down to the household and the business and the community level, the communities have to accept a degree of a trade-off, right? The entire insurance market is basically a gigantic algorithm, except in today's world, in the analog economy, we don't trust you. So the burden of proof is on you, the policyholder, to come to me, the insurance policy, to prove that you're not trying to defraud me, that you're not deliberately claiming a loss so that you could benefit from it. But imagine a world in which that happens parametrically. Technology like blockchain, not alone, but like blockchain, along with georeferencing and along with other types of triggers, can enable that type of insurance liquidity to be in the hands of people and communities and households instantaneously. Think about this false proposition we gave the entire Florida Panhandle. When FEMA ordered an evacuation because of Hurricane Irma, we effectively had the largest ordered evacuation in U.S. history. But an ordered evacuation to a household that can't survive a $400 financial setback is effectively, at worst, a death sentence, at best, a prison. The prison is poverty. How do you resolve for that? You need to figure out how to get community and need matched with capital so that the ordered evacuation is provided with the capability financially to take that on. So imagine a homeowner's insurance policy that had a rider that said, if you leave and if you preserve safety, forget property, we could rebuild a house. But if you leave, we'll give you your deductible in the equivalent of a credit paid instantaneously because your geo-reference location is going to be underwater before this claim hits. Now the market is incenting people. Why should we do this? This isn't altruism. As I said before, blockchain is an augmenting technology, not a disruptive one. This is not meant to be altruistic. It's meant to augment the type of trust we expect of people in my industry. We're trust brokers. An insurance policy, like a lottery ticket, is the only legal contract where if you ever claim it, you'll gain more than you ever paid into it. Doesn't happen in any other instrument but insurance and lotteries. So imagine if instead of having to prove that you're not a criminal to your homeowner's policy or life insurer or any other class of insurance, but to have the trust paid out and recognized to you instantaneously. Another plug for Forbes, I have a piece in there talking about the same issue. Insurance is a great form of protection for those of us who can afford it, but a terrible form of liquidity. And what the market needs right now, in a world with an embarrassment of riches looking for yield, and in a world with low levels of resilience, looking for greater financial resilience to be able to stand back up when crises hit, is we're looking for liquidity. It's not enough to say, we will be there 18 months after the disaster in Houston or Puerto Rico or Florida or anywhere to help you rebuild. You need to be there now because that type of economic displacement hurts communities long range. The Gulf post-Katrina has never recovered its population. So net, failure to resolve these issues, in my humble opinion, is partly a failure of imagination and partly a failure of leadership because a lot of companies gain massively from status quo. But this is the last of the ironies, I guess. How am I doing on time? 2 minutes. Brilliant. Here's the last irony. It's a double jeopardy. So if you're the insurer and you're the large asset holder whose balance sheet I'm attached to, you have a double jeopardy. Because these companies, through a process known as asset liability management, on the one front, they're the largest center city property owners to manage long-term liabilities on their balance sheets. So if you're living in a world like this one, where your actuarial models are thrown right out of the window, Houston had 3 500-year flooding events in 3 consecutive years. So that's 1,500 years worth of floods. You can't price the math effectively unless you come up with a better way of organizing capital. A source of organization of capital that allows you to create a 30 to 50% quantum, get rid of the expense ratio. Cryptocurrencies, blockchains, and tokens enable us to do that because all they are at the end of the day is a digital representation of a claim and a counterparty to a claim. That's the entirety of the insurance industry in a nutshell. And so the technology can help augment the things we do best at a time when the market and you need it most. Thank you. Thank you.